Imagine running a business where you push 15% more product out the door, right? You bring in millions more in revenue, and then at the exact same time, your total profit is just entirely slashed in half.
Which is usually a disaster.
Exactly. If you're a traditional retailer, that is a catastrophe. But today, we are looking at a multi-billion-dollar platform that just did exactly that. And they're actually signaling to the market that it's a massive victory.
Yeah, it really is a fascinating paradox.
So welcome to today's deep dive. We are tearing into the Q1 2026 earnings report and the accompanying credit performance charts from LexinFintech.
Right, and for those of you following the space, you know Lexin is a heavy hitter.
Oh, absolutely.
Right.
They're a leading technology-empowered personal financial service enabler in China. Basically, they act as the central nervous system, connecting consumers directly with institutional financial partners.
And we are dealing with staggering scale today. I mean, 250 million registered users.
That's just massive.
To put that scale into perspective, that user base is actually up 7.6% from just a year ago. We are looking at 38.2 million cumulative borrowers who have actively drawn down loans on this platform.
Wow.
Yeah. So when a macroeconomic environment gets as complex and, well, uncertain as the one we're in right now, you cannot simply hide an ecosystem of this size.
Right, you're a giant target.
Exactly. The broader economic headwinds are going to hit your balance sheet. The real story here is how you absorb that impact.
Which brings us to our mission for this deep dive. We want to extract the absolute most critical insights from this pretty dense financial release to understand the underlying mechanics of modern corporate defense.
Yeah, figuring out how they weather the storm.
Right. We want to know how a platform with hundreds of millions of users manages to pivot its core business, insulate its balance sheet, and somehow still grow its loan volume. Okay, let's unpack this.
Let's do it.
The top-line numbers look incredibly aggressive. In Q1 2026, Lexin's total loan originations hit 57.9 billion RMB.
Which is a lot of money moving through the system.
A ton. That's a 12.2% increase year over year from Q1 2025 and an almost 16% jump just from the previous quarter.
Right.
And total operating revenue sits at 3.3 billion RMB, up 6.6% year over year. So cash in the door is up. Transaction volume is up. Yeah, but then you look at net income.
Yeah.
And it comes in at 201 million RMB. Year over year, that is a brutal 53.2% drop from the 430 million they reported in Q1 2025.
What's fascinating here is that the missing net income didn't just evaporate.
Right, it's like a restaurant serving 15% more meals, bringing in way more cash, but taking home half the profit. Like, where did the money go?
Well, it didn't go to operational bloat or, sudden inefficiency. It was deliberately redirected into structural buffers.
Okay, structural buffers. Explain that.
So if you look at the mechanics of Lexin's business, they facilitate off-balance sheet loans where they provide a guarantee to the institutional partners who are actually funding those loans.
Right, they're the middlemen carrying the risk.
Exactly. So as their origination volume scales up in a really rocky macroeconomic climate, the cost of guaranteeing that volume just skyrockets.
Got it.
So they aggressively bumped up the provision for contingent guarantee liabilities. It went from 677 million RMB in Q1 2025 all the way up to 959 million in Q1 2026.
Wow. Okay, so that is a massive capital sink.
Oh, yeah.
They are basically choosing to aggressively lock down liquidity on those off-balance sheet loans rather than post a pretty net income number for the quarter.
Exactly. It's highly defensive.
It's like they're effectively paying an insurance premium to themselves. They're locking capital in an escrow that they can't touch for growth, just freezing their own cash to guarantee system stability down the line.
Exactly. They are proactively pulling forward potential future pain and just pricing it into today's earnings. And they're doing the exact same thing on the operational side, too.
How so?
Well, processing and servicing costs rose from 551 million RMB to 634 million. And management explicitly notes that this jump is driven by increased risk management expenses.
So they're spending more on the underlying tech.
Right. They are deploying a lot more capital into their algorithmic underwriting and their manual review processes before the money ever even goes out the door.
Okay, but here's the crack in the armor. You can buy all the defensive buffers you want, right? You can spend heavily on risk modeling, but eventually those loans are out in the real world.
Sure.
And the real world right now is pushing their 90-day delinquency ratio up. It sat at 3.1% at the end of 2025, and by the end of Q1 2026, it crept up to 3.5%.
Yeah, you see the macro pressure there.
Right. So the mechanics of their underwriting are undeniably facing friction from the macro environment. I mean, if the 90-day rate is going up, aren't they technically losing the battle?
Well, no, because you can never perfectly insulate a consumer credit portfolio from widespread economic headwinds.
Okay.
When household budgets get tight on a national scale, a certain percentage of late-stage delinquency is just mechanically baked into the model. You can't avoid it entirely.
So you're saying it's expected.
Absolutely, but you have to analyze that 3.5% trailing indicator alongside their leading indicators.
And what do those look like?
The report shows their 30-day plus first payment default rate, so early defaults for new loan originations. That metric remains highly suppressed at below 1%.
See, I look at that first payment default metric like a nightclub bouncer.
Okay, I like that.
Yeah, a sub 1% rate means the bouncer at the door is ruthless. They are checking IDs, screening the line, making sure that the obvious troublemakers, like the inherently bad loans, never even make it inside the club.
Right.
But the rising 90-day delinquency rate tells us that some of the patrons who got through the door perfectly fine are, a few hours later starting to cause issues because the overall mood in the room is just deteriorated.
The bouncer analogy totally holds up, but here's the twist.
What's the twist?
Lexin didn't just stand at the door hoping things would calm down inside. They actually changed the music to get the risky patrons to leave earlier.
Oh, interesting. How did they do that?
They proactively pulled their weighted average loan tenor down from 13.4 months to 11.4 months.
So they're forcing a faster capital rotation.
Exactly.
By pulling their tenor down, how exactly does that protect their yield mechanics, though?
Well, it drastically reduces their exposure window.
Okay.
Think about it. When you originate a 13-month loan, you are locking in a specific yield against a consumer's financial profile as it exists today.
Right, which is a snapshot in time.
Exactly. But in a volatile macro environment, a lot can happen to an individual's cash flow in over a year. People lose jobs, expenses jump.
Yeah, a year's a long time right now.
It is.
Yeah.
So by compressing that timeline to 11.4 months, the capital turns over faster. It allows Lexin to continuously reprice the risk.
Oh, I see.
They get their principal back quicker, and then they can reassess the borrower's current health before extending credit again.
That makes total sense. And we actually see the physical manifestation of that strategy in the portfolio size.
We do.
The total outstanding principal balance of loans decreased by 10.1% year over year to 96.5 billion RMB. So they are originating more new volume, but the total float out in the world is physically smaller.
Yeah, it's a tighter, faster-moving pool of capital. And if you dig into the provided credit performance charts, specifically the vintage charge-off curve, you can see the mechanical success of this strategy.
For those listening who might not look at these charts every day, what exactly are we seeing?
So a vintage curve basically plots a specific cohort of loans, say all the loans originated in Q1 2024, right? And it tracks their cumulative defaults over time.
Gotcha.
In a failing portfolio, that curve just goes exponential. But in a controlled portfolio, it rises and then it sharply flattens out like a log function.
And looking at these charts, the newer 2025 and 2026 vintages are tracking slightly higher on the y-axis compared to early 2024.
They are, which directly reflects that 3.5% late-stage delinquency we discussed earlier. The macro environment is heavier, so the line is higher.
Makes sense.
But crucially, the curves still flatten out at a predictable horizon.
Oh, okay.
Yeah. The gap between the yield they collect and the charge-offs they suffer is maintained because the risk isn't compounding uncontrollably. Their underwriting engine is accurately predicting the plateau, even in a tougher economy.
Okay, here's where it gets really interesting, though.
Okay.
We've mapped out this highly defensive posture, right? Freezing capital and guarantee provisions, shortening the loan tenor, shrinking the overall balance.
Yeah, very defensive.
Yet total loan origination grew by almost 16% quarter over quarter. I mean, you simply do not generate that kind of top-line growth purely by playing defense on traditional cash lending.
You don't. You really don't.
So where is the growth coming from?
You generate it by fundamentally altering what you are actually financing. Lexin is executing a massive ecosystem pivot right now.
A pivot, okay.
Yeah, the earnings report reveals that their non-consumer finance business now accounts for nearly 50% of their total loan origination. Half of their volume is coming from entirely different structural channels, specifically things like installment e-commerce, offline inclusive financing, and their tech empowerment services.
Okay, I really want to zero in on those installment e-commerce numbers because
Mm-hmm.
the growth velocity there is just
It's
staggering.
huge.
The gross merchandise volume, the GMV for their installment e-commerce sector, exploded by 95% year over year.
Almost doubled.
Yeah, it hit 2,198 million RMB in the first quarter, moving through over 600,000 users.
So from a mechanical risk perspective, how does financing an e-commerce purchase differ from just, handing someone a traditional personal cash loan?
It is an entirely different risk profile.
How so?
Well, when you issue a pure cash loan, you face fund diversion risk. You give a borrower cash to, say, consolidate debt, but they might just take it and gamble it on crypto.
Right. Once the money leaves, you have zero control over the endpoint of the capital.
Exactly.
Okay.
But with embedded installment e-commerce, the credit is injected directly at the point of sale.
The borrower never actually holds the cash. The capital goes straight to the merchant to clear the transaction for, an iPhone or a refrigerator.
So you are eliminating the friction of fund diversion entirely.
Completely.
And I assume you are also getting a pretty massive data advantage there, too.
An unprecedented data advantage. You aren't just looking at their credit score anymore. You are capturing granular purchase intent.
You know what they're buying.
Exactly. You know exactly what they are buying, from whom, and at what price point. This acts as a structural buffer against pure lending volatility because the underlying asset, the actual consumer good, anchors the transaction.
Okay, but hold on. Let me interrupt right there.
Sure.
The active users metric sits at 5.2 million, which is up 8.6%.
Right.
But right next to that, the report states that a jaw-dropping 89.9% of total loans came from repeat borrowers.
Yeah, almost 90%.
Now, management spins that as incredible loyalty, right? But if I am looking at that from an investor's perspective, I'm thinking your customer acquisition has completely hit a brick wall.
Yeah.
Like, does an almost 90% repeat rate mean they're just bleeding out on the front end and failing to bring in new blood?
If we connect this to the bigger picture, it changes the narrative completely. In a high-risk macro environment, aggressive customer acquisition is actually a fast track to destroying your balance sheet.
Really? Why?
Think about the mechanics of customer acquisition cost, or CAC, versus lifetime value. When the economy is healthy, you spend heavily to acquire untested users because the overall default probability is low.
Right. Everyone's paying their bills.
Exactly. But when the economy turns, the CAC on a new user is a massive gamble because you lack proprietary repayment history on them.
You are basically flying blind with new users.
Exactly. You have no idea how they behave under stress. But a repeat user comes with a proven internal synthetic credit score.
Oh, because they're already in your system.
Right. You know their exact behavioral cadence. Remember, Lexin has 38 million cumulative borrowers who have successfully navigated their ecosystem over the years.
That's a huge pool.
It is. So why would you spend premium marketing capital to underwrite strangers when you have a captive audience of millions who have already proven they can manage your 11.4-month loan structures?
I see.
Yeah, so that 89.9% repeat rate isn't a failure of acquisition. It is a calculated, deliberate retreat to the safest possible yield.
It's fortifying the castle.
Yes.
They bring you in, you buy a laptop on their e-commerce platform, you build a pristine internal repayment history with them, and then they just continue to serve you high-quality short-term credit.
Creating a highly sticky loop.
A very sticky loop. Okay, so we've established that the underlying mechanics of the business, the provisions, the fast capital turnover, the e-commerce pivot, they're sound.
They're very sound.
So what does this all mean for the shareholder right now?
Well, the management's capital allocation strategy tells us exactly what they think of their own underlying mechanics.
All right, the buybacks.
Yes. Lexin utilized their share repurchase program to buy back approximately 9.6 million American depository shares for around $39 million US.
Wow.
And that move retired 5.9% of their total outstanding shares.
Okay, let's break down the mechanics of a buyback at this specific moment.
Yeah.
Because frankly, doing this while your net income is down 53% seems, well, completely counterintuitive at first glance.
It does, but by retiring nearly 6% of the public float, they are artificially shrinking the pie.
Okay.
We spent the first half of this deep dive discussing how management heavily suppressed their net income by hoarding capital in those contingent guarantee provisions, right?
Right, paying the insurance premium.
Exactly. While that ensures the long-term survival of the company, it heavily punishes the short-term earnings per share metric.
Because the profits look so low.
Right. So by stepping into the open market and eliminating 6% of the shares entirely, they are actively defending the remaining shareholders' equity.
Oh, I get it. Even with a lower net income, there are now fewer slices of the pie.
Precisely. Which protects the value of each remaining slice.
It's a massive signaling mechanism.
Yeah.
I mean, you do not spend $39 million on your own stock if you have internal models predicting a liquidity crisis.
No, you would hoard every single cent of that cash.
Right. So it's a profound statement of balance sheet confidence.
It really is.
But, and this is where the narrative gets complicated again,
Always does.
right after executing this massive buyback, management issues their forward-looking guidance for Q2 2026.
Right.
And they project that total loan origination will remain relatively flat. Now, we just talked about them growing originations by 16% this quarter, pushing nearly 58 billion RMB out the door.
Yeah.
Guiding for flat growth feels like just slamming on the brakes.
This raises an important question about the tension between public market expectations and prudent risk management.
Okay, unpack that.
Well, public markets demand relentless, compounding, quarter-over-quarter growth always.
Always. Up and to the right.
Right. But structurally, you just cannot compound a consumer credit portfolio indefinitely in a tightening economy without inevitably lowering your underwriting standards.
Because you run out of safe people to lend to.
Exactly. If they wanted to hit another 15% growth target next quarter, they would have to start letting those high-risk patrons pass the bouncer.
Which completely destroys that sub 1% first payment default metric we analyzed earlier.
You've got it. So flat growth guidance here isn't a failure. It is a tactical pause.
Tactical pause. I like that.
Management is explicitly communicating that they are staying vigilant regarding persistent macro uncertainties.
Right.
They need to digest the massive origination volume they just booked.
All right.
They need to let that 11.4-month paper season and observe how those vintage curves actually behave out in the wild before they accelerate again.
Right. Make sure the math holds up.
Prioritizing flat, compliant, high-quality operations over reckless expansion is exactly how you survive credit cycles.
It's prioritizing the integrity of the hull over the speed of the ship.
Perfect way to put it.
You know, whether you are analyzing a multi-billion-dollar fintech conglomerate or advising a startup or, honestly, just managing your own personal household budget, the mechanics of Lexin's Q1 playbook provide a pretty incredible masterclass in cycle resilience.
They really do.
When the macro data gets unstable, you don't chase yield blindly. You freeze capital in your reserves. You compress your exposure timeline so you aren't trapped in these long-dated liabilities.
Yeah.
You aggressively pivot away from unsecured risk by anchoring your product to tangible e-commerce transactions. And most importantly, you lean entirely on your proven, retained relationships rather than bleeding capital to acquire unpredictable new ones.
Stick with who you know.
Exactly. Lexin took a massive, calculated hit to their headline net income, but beneath the surface, they engineered a fortress.
And if we connect this to the bigger picture, there's a lingering implication here that goes far beyond LexinFintech.
Oh, what's that?
It has to do with that 89.9% repeat borrower metric we talked about. When a platform reaches a scale where nearly all of its multi-billion-dollar volume is generated by users continuously living within its ecosystem, it fundamentally changes the definition of the product.
So it transitions from being a discrete financial tool into just a permanent commercial environment.
Exactly. I mean, historically, taking out a loan was a distinct, heavily considered event, right? You went to a bank, you signed paperwork for a specific external need.
Yeah, it was an errand.
Right. But platforms like this are seamlessly weaving credit into the daily consumption layer through e-commerce integration.
Right, it's just a button at checkout.
Exactly. It leaves you with a critical thought to mull over. Are these platforms evolving from temporary financial intermediaries into lifelong commercial companions?
Wow.
The friction between having money and accessing credit is completely disappearing. It's something to deeply consider the next time you are checking out online, and the system instantly offers you a beautifully integrated short-term installment plan.
You aren't just buying a product. You're actively participating in the exact macroeconomic balancing act we just dissected.
Exactly right.
The tightrope is everywhere. I think that is a perfect place to leave it. Thank you for joining us on today's deep dive.